Okay, welcome everybody. This is Ready for the Bell Trading Group. My name is Kevin. We are going to chat about two things today. One is a follow-up to last week's introduction to currencies and a little bit more of how they work and how we are going to trade them. And a follow-up to that, we're gonna look at charting. And then we're going to place a bull put spread and why we like the strategy of a bull put spread. So first off, my policy my outlook on the market hasn't changed much since Monday, but there's a couple things that I wanted to bring up that you guys should put into your favorites. And that is this website right here. This is called Forex Factory. It's a nice little website that gives us the economic calendar throughout the week. I've got the settings changed on it just a little, filters. These colors represent significance. Orange is sometimes important, sometimes. Yellow and gray are not important at all. We are really just focusing on the red. And the red represents growth, inflation, employment, central banks, etc. And it represents for all the major economies, such as Australia, Canada, Switzerland, China, Europe, Great Britain, Japan, New Zealand, and United States. So these are obviously the major economies and the only things we really care about in terms of what's going on in the economic world. So this is this week. And the reason I brought it up is because of this guy right here. Federal Reserve Chairman Powell had some things to say. Now, on Monday, I talked to you guys about where we think the market's going, and a lot of you have a sentiment of bullish. You think that we are going to go up and keep pushing the bar, and etc. Well, you may just be right based off of what his comments were. This is just a tweet, but you can read his actual press release if you wanted to. We're not going to do that, but Powell thinks that the pace of improvement is slowing. He thinks the recovery has been uneven. So basically, he's not thrilled with what's going on in the market. He's definitely not happy about how the recovery has slowed down since we've got an uptick in cases and lots of other things, right? So what does that mean for the market? What does that mean for the United States? It means that we have been buying an extraordinary amount of debt, bonds, US Treasuries, and to make money cheap. And we have been doing that at an enormously strong rate for the last 7 months. 7 months, 8 months, March, 7 months. Anyways, so that just means that they're probably not going to change their agenda. And they're certainly not going to even consider raising rates. So that means two things. One, the dollar will continue to stay weakened, which is actually good for trade. And two, as long as money is cheap, Wall Street loves it. So bringing up the dollar really quick. That came out yesterday, and you can see right here, that was Wednesday, right there. Right? Yeah, that was Wednesday. And typically it's really kind of a non-event unless he were to say something crazy like, yeah, we're going to step our bond buying purchases by double. We're purchasing 50 billion a month. We're going to step it up by 100, and we're going to drop rates into negative territory, something like that. Then you would see this just look something like that, or even bigger. But he was mostly just noting that it's the recovery is slowing down. So it's like, yeah, welcome to the party, right? Of course, we all know that. But basically, he's saying, so we're not going to change our strategy. So that's putting this in even a stronger decision point. So we are right there. We are so very close to this support level. A break below this is going to send so many different things that we've been watching on a streak. Now, I can't say everything will break out for sure, but this is the indicator that I've been telling you to keep your eyes on. We haven't seen this break the support level, which is what we need to see the S&P start making its move. And the S&P is still, yeah, it had its breakout right here, but it's still in this channel, this massive widening channel, right? It needs to start moving, and it very well could. It broke the high here and has not traded below this area since. It broke the high there and has come back down, and we may be forming a bull flag, which is one of the things we're going to be talking about today. We're going to get into charting. So this is big. This should be a radar. This should be on your radar. A break below this level could be the catalyst we need to see this continue on up. However, I don't see that really being the case. I'm seeing flashing signals, warning signs saying that we might be due for a sell-off, or not a correction by any standards. Nothing even close to this. There's just the data is not there by any means. We're doing well. If there was no COVID, this wouldn't even happen, right? So economically, we're strong. We're doing well. So when I say sell-off, I mean just taking a breath, right? Maybe retracing by 50%. And for me to check out how I do that, I go pull up my Fibonacci retracements. I go from here to there. So we're looking at maybe to here. Okay. So we start here, we go to there, right? Maybe we get to 50%, maybe lower. You never know. But I'm talking about maybe this much of a move. However, a close, where we go? If we were to see a close down, if it were to start trading down like so, if we were to see it close below this 50% level right here, I would actually become more bearish, just because now it's on the opposite side of that 50% level, which once we get below the 61% level on the Fibonacci, now the trend in this short-term move from here to there is now on the bearish side, just in that short-term move. So what I'm getting at here is we're getting a lot of signals saying that there's pressure, there's resistance that's suggesting that it might correct a little bit before we get that move. So let's be mindful of that. So how we look at that is we look at the dollar and we look at our currency pairs. So I talked a lot about this on Monday, and I said, what are the things that we look for? We look for what's happening in the Forex market, the currency market, because governments dictate policies. Policies move hedge funds move the stock market. So if, excuse me one second here. If the smart money is, and I talked about smart money and, smarter money, future money, all that. If the smart money is ready to go bullish, they can't quite do that until currencies say, yeah, let's do it, because currencies are governments. So they're waiting. They're getting pressure, and the governments are not quite there yet. Powell's statement saying that it's not recovering at the pace that they'd like doesn't really mean anything. They're not going to change their policy. They've already got, their guns out. They've got they've got 245s out. There's not much more they can carry in their waist. The more that they put out there, it would put us in more of a risk in terms of recovering for future references. So they're not going to do a whole lot in changes, not likely anyways. So that means that we could have the stimulus that could do things, right? But that has nothing to do with the Federal Reserve. So until we get more signs on that, which there hasn't been a lot, we are at status quo. So let's take a look at these pairs, and let's just run through the yen pairs really quick. Aussie yen, as we talked about many times, this is that pair that is the correlation of forex pairs to the S&P. So if we're looking at this, we saw it hit this resistance area, right? Now, I've talked about this before in last week's class. On a quick review, remember, Australian dollar versus Japanese yen, 72.53 represents how many yen it would take to buy an Australian dollar, okay? So basically, the Australian dollar is much stronger than the yen. What we're looking at here is, weaker. What we're looking at here is we're looking to see which direction this will go. In stocks, we only care about one thing. When you buy a stock, we want it to go up. That's the bottom line, right? Well, in currencies, we don't care. I am not biased whatsoever. Australia, I'm sure it's a wonderful country. I will sell it and buy it. Either way, I'm looking for a move on this because currencies are dictated by central banks, and the central banks will make changes in order to favor their economy. If their currency gets too hot, becomes overly strong, they're going to weaken it. If it gets too weak, they're going to strengthen it by using all kinds of tools within their arsenal. So these things are constantly moving up and down. So I won't look for a bearish play on a stock, even though we look for signals just to see what's going on. But I will certainly look for a bearish play on the Australian yen. And what we're seeing right now is we are seeing resistance. Okay, it hit this area multiple times. Now I'm going to talk about a chart. I'm going to talk about how we read these charts, and I do this all the time. I always say different funky names, head and shoulders, and wedges, and shooting stars, and all kinds of funny things. I swear I don't make these up. They're real things. And there it is. Here is a chart that I put together for you guys. Well, I grabbed it, but these are the patterns. Now, right there, that says reversal pattern. And I've said head and shoulders multiple times. So on a stock, we look at patterns just to see where maybe there's going to be resistance and to see what extra plays might happen. But if there's a reversal pattern, meaning it's going to go down, I'm not going to trade that. I might look for opportunities if it looks really good, and I think that there might be a lot of pressure, say for instance on tech stocks. Tech stocks have had a big run. We'll talk about that later. But currencies, totally different story. In currencies, they go up and down, like I just said. So because central banks are always manipulating whether or not the currency is going to be strong or weak, we do very, very, very much care about these patterns. So you can see right here, reversal pattern, double top, head and shoulders, rising wedge. They all mean that if this pattern plays out, we should see it break out, okay? If you see a head and shoulders, if you see this pattern going like this, we should see it break out. Rising wedge, when you see it getting narrow and narrow and narrow, we should see it break out. But the bottom line here is we are focused on on these patterns on currencies because they will break out on the downside and the upside. So they'll go both ways. I will absolutely share that, Katie. I will definitely share that. Will you remind me at the end of the class, please, please? Okay, so let's draw one here. We've got a pattern right here. So let me bring this up really quick. Can someone tell me what they see right here from here? Rising monkey, okay. Do I have rising monkey on here? No. Okay, but yeah, that is, yep. That's actually a real thing, Tone. I don't know if you knew that. What? Yeah, it's a candle formation. Anyways, what do we see here that we could have saw there? We see a wedge. Okay, yeah, I see a wedge. What else do you think you might see? I'm going to bring it up again. Now just focus on this area right here. What do you guys see? What I'm seeing now, of course, this isn't perfect, right? But yes, Katie, I'm seeing a head and shoulders. So you guys, it's never going to look perfect. It's never, ever, ever going to look perfect. You gotta, there is no black and white in trading. There's lots of gray, right? It's not just one way or the other. There's lots of in between stuff. So if you ever see a pattern that looks literally perfect, it's probably not going to work out whatsoever because it's too perfect. So what I'm seeing is a head and shoulders. So here we've got our shoulder, our head, and our shoulder. Okay. So that's what I'm saying. Like I said, it's not perfect, but we have to identify it because there is an opportunity here. On the flip side, let's go ahead and bring up our moving average and pivot points. On the flip side, if this thing breaks out, that means that the S&P has to sell off, right? Because if this thing is so tightly correlated to the S&P, then it can't go down if the S&P is going up. That's why we watch this stuff. That's exactly why. If we keep coming down, I'm going to go ahead and get rid of this. If this keeps coming down to, say, this level right here, all the way down to here, come on, there we go. If it comes down all the way to here and then breaks out, that would give me an indication that the S&P is going to experience a sell-off, right? So we want to watch this, although that's a pretty far way a ways, right? Just from here to there, that's 200 pips. That's a big move. So in order for that to get down there, we just have to start seeing some sell-off now. Another thing I'm seeing here is a bull flag. Now, in order to get a bull flag, you have to have a trend. So let's just identify what an actual bull flag is. How do we know how far back to start our pattern? That's a great question. So, Tony, what you have to do is when I start looking at this, so if I'm looking only here right now, I could say, hey, here's my shoulder. Not really, because it could have easily just kept going up or went further down. Who knows, right? So I have to wait. And I could say, ooh, maybe I have a double top. That looks familiar, doesn't it? So we got a high here, bounced off of it. We could have had a double top right there, but it didn't come back down. So now I'm watching and I'm watching and I'm watching. Okay, I'm not really seeing a whole lot of anything. I guess you could call this a wedge, but not really because it broke out here. I would have said maybe this is a wedge right there. Hello. And I actually did trade that because it was a bit of a wedge, but it wasn't that solid. So Tony, what I'm getting at here, and everybody, what I'm getting at here is how far do we have to go back? Well, if we're watching this as it's going, we don't have anything right now, really. We had a possible head and shoulders, but in order for a head and shoulders to play out, it's got to go up here, which it did, come back down. It went back up again. It had to come all the way back down to here. And then it had to break below this area for it to be a confirmed head and shoulders. It did not do that. It just kept going and going. Okay. Now I'm watching. Oh, interesting. Okay. Look at this sell off. This sell off. Here's a shoulder. Maybe this is a head. I really don't have anything yet. I got nothing yet. Okay. Okay. Maybe I got a shoulder here. Maybe. No, I got nothing. Oh, it starts a break. No, it's got to come back down to this kind of, it's got to kind of break this level here, which it kind of did. And then it ran back up. And then, okay, now I'm seeing something here. Now I've got a big old shoulder. I've got my head, and I've got another shoulder right here. Okay, so I'm watching this play out. How far you have to go back is until you can see something. So if I'm looking for another pattern back here, well, patterns are good to look for and draw out so you understand, but it's really pointless because it already happened, or maybe nothing happened, right? What we are going to look at some patterns on flags and stuff just so we can see, so you can understand. But in order to figure out how far we have to go back, we just have to go back far enough that we can see something. Now, if you're wondering, well, how am I going to know? I'm going to send this to you guys, and you're going to post it on your wall, or you're going to post it on your background. You're going to put it somewhere so that every time you pull up a chart, you have that. That's your reference. This is going to be your cliff notes, your cheat sheet, whatever you want to call it, right? This goes with you everywhere you go in terms of when you're charting, when you're looking at stocks, when you're looking at currencies, whatever it is you're doing. This is just practice. I will continue to talk about patterns, and you'll start to recognize them. So this is a head and shoulders. Let's look at a flag, because I actually see some flag patterns. So what is a flag? Where are we? There we go. I don't have a flag on here. All right. Well, a flag is this. A flag is a continuation pattern. A continuation pattern, zoom in here, is continuation of the trend. So pretend this is real time. We have no idea what's going to happen next. So we're moving. Okay, it's kind of on a little bit of a rally, a little bit, right? Okay, we're moving. Oh, selling off a little bit. Selling off, and breakout. Breakout, higher. Okay, here we go. Selling off a little bit, selling off. And, oh, still selling off. Okay, now I think I see something here, and breakout. So what I see here is a flag. And a flag, again, these things will never be perfect, right? Is a pole. Here's your pole, right? Your run up, and here's your flag. Some short-term sell-off, right? Little bit. Now, we needed to make a slope, though. A little bit of a slope, like so. Like that. Flags can be even like this, but a true flag slopes like this, okay? And then how we know it's a flag is we wait for it, and after a certain period of time, we don't want these things to stretch out too long. If it stretches out, meaning it just keeps going sideways for too long, it becomes invalidated. It's no longer relevant. You can't consider it a valid pattern anymore. But here it didn't go too long. So here it broke out, and we're going to draw it out of our resistance area right here. Let's actually make our little flag, right? And boom, There it goes again. Now it came back down, but we don't care because it validated our pattern. And that's all we care about, right? So then wherever we had our target, whatever it was, hey, it worked out like it was supposed to, and we made some money, whatever it was. The way you measure out targets on this, there's lots of different variables, but this is a flag. We're looking for patterns like these so we can check to see what's going to happen next. So I see a head and shoulders, a big one, huge head and shoulders, huge, 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 huge. So the bigger it is, the bigger the move is when it goes down. However, that also means that if this is big, meaning it obviously from the start of this was back in June, and where we are now, we're in November, then you can expect this to play out almost as long. So that means that it becomes not as significant as we would like. We kind of want this to be about half that length. We kind of wanted this to do it in this amount of time span. From June to say September, we really wanted it to do this, 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 and then go. That would be a nice head and shoulders pattern. That would be something I would really sink my teeth in. Didn't do that, but that doesn't mean that it's no good. It's still a valid pattern that we want to keep our eye on. Another thing that you could look at here is, what do we see here? I just showed you back there. What could we look? What would this be called? Possibly. This could be another bull flag. It could be. Bull flag means obviously up, right? There's also bear flag. It's just the exact same thing, but flipped. For example, that would be a bear flag. See, flag pattern, down, right? So bull flags, bear flags. Bull flags are better because they're continuation patterns. Bear flags are good too. They're continuation patterns. We like bull flags better. Bull flags better because in stocks, we would never trade a bear flag. We would only want to go up, right? But in currencies, we'll do it either way. So this could be a bull flag. It's kind of starting to unvalidate itself, right? It's a little too deep, don't you think? If we're looking for this to do something more on this line, if we're looking for it to do more of this, right? It kind of went a little too deep. I wanted it to hover in this kind of consolidated range. It sold off. If I were to zoom in a little bit in terms of time, which is what we want to do when we're looking for entries, if I were to drop this down to a 4-hour, I would say that it broke this support area. And now it's trading below it. Okay, so I don't think it's really a bull flag anymore. But these are things that we look for because we want to make sure that we know what's going on, what to expect. In currencies, charting is everything. It is so important. And going back to currency and going back to the basics of currencies, yen pairs look a little different than, say, dollar related pairs, meaning EUR, USD, euro, dollar. You guys can see there it's 1.18750, right? So the fourth decimal place represents 1 pip. On this one, on Aussie yen, the decimal place is only there's only 2 decimals out from that marker right there, but it doesn't change anything. Instead of, let's bump this up. So instead of it being, so where are we? We're 75.67. So hey now. There we go. It 75.67. This still represents 1 pip. So just pretend that this decimal place is right here. So 1 pip, 10 pips, 100 pips, 1,000 pips. Okay. So that's what that represents, right? So when this thing goes from 66 to, if it were to continue to go down to 56, so 5, 6, so we got 11 pips. And if we sold it, we'd be up 11 pips. Okay. So I'm looking at these things for two reasons. One, I'm going to trade the heck out of them, and I really want you guys to get on board with that. Two, I look at them to see what's going on here. If everything is pressuring things to not continue up, but it's also not pushing it down, that's a warning signal. That's a continuation might not be there right now. There's so many different factors in play right now. Our president still is not. We haven't even started the transition yet. We have COVID. We have holidays. We have all these things, but don't let the holidays fool you. The Santa Claus run, the shopping run, there's the Black Friday run, whatever you want to call it. The Santa Claus rally. There's all kinds of different names for it. December can be a huge mover in the markets. It can be big. The only time in the markets where I could say you can guarantee slowness is summertime. But in the wintertime, holidays are there. People do go on vacation, but sometimes the Santa Claus rally, it can be big. So we could see this make that move. So we're watching these currencies to see what's going to happen. This being one of the most important. Let's go back to a daily. This being one of the most important, but all of the yen currencies being important. GBP, JPY. Okay, all these are important. Here I see another head and shoulders pattern. Okay, so remember, a head has to be way bigger than the shoulder. So Tony, you were asking how far do I need to look back? I need to make sure that the shoulder is not greater than the head. So as we can see there, the head it's got a higher lip to it, right? So head's much higher than the shoulder, right there, and then vice versa, right? That's how we know that's a head and shoulders potential pattern. Same thing here with the Aussie yen, though. It's a big one. So we're waiting to see what happens here. Yen pairs all across the board are going to dictate what happens to the stock market. If the stock is all in and we're seeing tons of pressure onto risk on assets, we should see all these currency pairs all across the board. Actually, this is not a good example because these are both risk on, risk off assets, but we should see EUR, JPY. We should see Canadian dollar, yen. We should see New Zealand dollar, yen. We should see all of these things pushing higher if the market's going to rally, right? Because when the stock market rallies, they dump all their safe haven assets, which is absolutely the yen. And it's not really doing that. So keep an eye on these. Question while I move on to the next thing here. Has everyone had an opportunity to get their Oanda account set up? Because you guys, we have a big opportunity on a few of these pairs. Euro yen is one of them. In particular, I'm looking for this area right here. If we do get that sell-off, look at how close we are from this breakout line. We're only about 90 pips away. That's not very much. So if you think about that, if we're only 90 pips away, from here to there was 200. So you can believe it. If we get some kind of news, some kind of shocker, this market just sells off. You know how fast they can move. This could make a move very quickly. And unlike options where we have calendars that we have to pay attention to and we have to put into the equation, there is no calendar. You can hold on to it for a day, for a year, for 2 years, whatever you want, right? So we're going to be ready to just get into this and start adding contracts, this could be a very, very good move. And we don't want to miss that. So I just want to make sure that you guys have those, have your accounts set up. So let me know if there's anything I can do to help there. I really don't want you guys to miss that. Now, some of you had said, I don't really feel comfortable with Forex yet. And I don't blame you. If you're brand new to it, it's a little bit of a daunting market to get into. It's unknown. It has a lot of risk to it. You've never traded it before. There's lots of variables, factors, right? Well, that's why we're here. That's why we talk about these things. That's why I'm here to guide you guys. And the other thing is, you need to open the account and paper trade it. So if you're not comfortable throwing on real money, that's great. I don't want you to. I want you to do what you're comfortable with. So, when I make a recommendation of something that I'm trading, right? I'm looking at things that I would do. If you don't feel comfortable doing that, you should not do it. So in order for you to get comfortable, you've got to start trading. And if you guys have any questions on how to set that up, let me know. Try and get that set up before this weekend, if you can. That would be awesome. Let's go ahead and bring up stocks. Out of yes or no, send this into the chat. A yes or no, how many people have placed one option? A single option. Throw that in the chat for me, just so I can kind of have an idea of where we are. Okay. Katie, Joyce, David, okay. Tone, okay. Okay. So we're pretty mixed. We're pretty mixed across the board. How many of you have ever done how many of you ever have sold options? Meaning you maybe you bought a call. How many of you have ever sold calls, sold puts? Out of the people who have said yes to trading options, have you ever sold options? I'm sure you bought them. Have you sold them? I've sold puts. Okay. No. Okay. So this is going to be very new to everybody. And this is going to be a strategy that we are going to trade a lot. And this is considered an intermediate strategy, but I don't want you to feel daunted by this. This is something that you will get used to over time, but I'm going to make this so simple to follow. Just rewatch this. It's really not as difficult as you think. So we had talked about Bank of America as one of our examples, but what I want to bring up is these are some of the trades that I've been into, and these are all trades we talked about. And one of the ones I want to bring up is Kohl's. So Kohl's, as you guys can see over here, it's doing quite well. It's up. It's 56% max profit. Obviously, max profit is 100%. So it's about halfway of getting to our max profit area. So it's doing really well. And what this was a bull put spread. Okay. Now, what they mean by that is they mean a spread of buying two different options at the same time. They bought it and sold it at the same time. You can see right here that I sold some puts and I bought some puts at the same time. Okay, that's what they call a spread. All right. And the reason they call it a bull put spread is because when you sell puts, you're looking for the stock to go up or stay flat, but at least above your strike price, right? So that's the goal of this. So that's why they call it a bull put spread. You win as long as it stays above your strike price, and it can really go to, it can go pretty high if it wants to, and we'll still make good money on it. But as long as we stay above that strike price. Now, I'm going to talk about how you do it, and this will help you start just getting into options. And for those that are seeking to get a little bit, learn a new strategy, this is a good one. Where's the thing? Here we go. Okay, so I talked about in the past, we're going to talk about two stocks. I talked about Bank of America, and I said, hey, banking stocks are ripe. They look like they're ready for some action here. And I said, hey, if this goes down to 22.50, I definitely want to buy it. Didn't go down there, which is great, or which is fine, because it broke out of here, which is bullish, right? So the strategy of a bull put spread is, to be bullish, right? We don't want this annotation tool kills me. We don't want this thing to go down. That would not be good for our trade, right? We want it to go up. We want it to do this action right here. So now that we've got confirmation that this thing is potentially on the rise, even if we get a sell-off in the market, I think we're starting to get out of this bearish territory. What do you guys think? Do you think we're going to come back down to these lows? Do you think there's possible that we'll revisit? Do you think there's still potential weakness there? I certainly don't. I see this as a very bullish indication just on a technical standpoint. And by the way, this is a pattern. It's a wedge. Okay, bilateral pattern. So right there, a symmetrical triangle or a wedge. Okay, look at that. Now that's a good looking pattern. It's a handsome pattern right there. That looks very familiar to me. So a symmetrical wedge means bilateral. It can go either way, but that definitely played out. And now it's bullish. It broke out. Now we're interested in getting in this. So I said to you guys, if I wanted to be into this and own the stock, why not make some money? Why not get paid to own the stock, own it, get paid some more, and then decide if I still want to keep it? Why not get paid to own the stock? When you own stock, you need to go up in order for you to get paid, right? If you buy the stock and it kind of just fiddles around here, or it just makes a small move, and it's really not doing much for you except tying up your margins so you can't do other things, right? So that's why options are sexy, because we can get paid to own our stock multiple times. So what I mean by that when I keep saying that is, if I were to do a bull put spread, if I were to sell a put on this, I would get paid by the premium. Okay, I talked about this in that one class, right? So I'm just going to put on a single order here, and currently we're trading at 26.98. So let's just say I sold the 26 put. Okay, if I sell the 26 put, right, I get paid 44 cents, or one contract I make $44, right? So going back to this, as long as this thing stays above 26, I make my $44. I'm happy. This, as long as this closes, as long as this expires above that 26, I make my money, right? Well, what happens when, come on now. What happens when it goes below that 26? What if it does that? Right? Let's go back to our trade. If I were to actually execute that, my max loss could be $2,556. Well, that sounds terrible, right? So definitely don't want to do that. So how can I do this and not risk so much money so that I am going to get blown up in this trade if it goes against me, which it can, because we can never be right in the market. We can do our best to see patterns and trade what we see, but sorry, when I say we can never be right, you can never guarantee that you'll be right. We are going to have high probability trades, meaning we're not going to trade things that have low probability. We're going to trade things that have high probability. So since I don't know that it's going to stay above this, why don't I buy a put? Meaning, if this thing were to trade, if I buy the 20, let's say the 25 put, if it trades below 25, I'm making money, right? If it closes above 25, I'm not making money. So on the flip side, why don't I sell the 26 put? So when this thing's going up, I'm making money there with my sell, and I'm losing money here, which is fine, because as long as the premium I made on that is higher than what this is losing, I make money. So that's where the spread comes in. Now, if you feel like you're totally lost on this, this is the easy part. Okay. We understand that when we buy a put, we want it to go down, and we understand that when we sell a put, we want it to go up or stay flat. But the most important thing here is that I want to own Bank of America. That's on my list of something that I want to own, right? So let's go over to Kohl's really quick. KSS, KISS. This trade's doing phenomenal. And I bought the 24. What did I do? I sold the 25 put, and I bought the 24 put. Okay. So I sold the 24 put up here, 25, and I bought it down here. So at first it was going against me. Now it's doing really well, as we can see right here, right? So all we have to do is look at this. Oh, it's 24.50, okay? So I sold the 25.50. You can see right there that it's up 15.12, and I bought the 24.50. It's down 12.91, right? The reason that I'm up so much more here is because I got paid to sell this, right? That premium. So this can go as high as it wants. That's right, I wasn't using that. This thing can go as high as it wants. It can go to 35. Because as long as this keeps going higher, my short put is making money. Now there comes a point where I hit max profit, and that's a whole nother scenario that we'll talk about. But when we're seeing this go up like this, we're happy for two reasons. I wanted to own Kohl's. So I got paid. Let's see, what did I get paid on this? Let's go to account statement. Let's go drop this down to options. And what's going on here? Oh, there we go. By symbol. Okay, so well, it seems to be missing. It's on my window. Oh gosh, where is it? Oh. Okay, well, I'll just do a little quick math here. I'm not sure why I can't seem to find that. Okay, calculator. Here we go. All right. So here's my trade right here for coals. There's 24.50, 25.50, right? So it's a difference of $2.03 minus $1.60. I paid 43 cents in premium for this, or I made 43 cents, right? So 43 cents, so $43. And according to my account size, I could risk a certain dollar amount. So I did 9 contracts. So my max profit on this is $387. Okay, that's the max amount that I can make. So if we go back to this, we can see that I am 56% of my max profit, or I'm up $220. So I have 15 days on this, right? This can go for quite a bit longer. If this was going against me, I'd probably want that time. At this point, this is going well. I'd like to see it get a little higher in my profit, but right now, I'm happy. I'm going to let it keep going because right now it's above it's above this area. I need this to come a little bit further down because remember, I sold the 25.50 call. As long as it stays above that, I'm good. The higher this goes, the profit stays roughly the same, but remember, it's getting eaten away in the bot put, right? Because every time this goes higher, this loses more money, right? But this is gonna continue to do well. So in order for this to get to max profit, it actually needs to come down a little lower. Are you guys still with me? Give me a yay or nay. And do we have questions? There's a lot to this strategy, but I just want to make sure that you guys understand the fundamentals of this because we are going to trade this, and trust me, it's a lot less complicated than you think. You with me? So, anyways, kind of with you. Okay, so don't lose me yet. Don't lose faith on me yet. Okay. Bottom line of this strategy is we want to own calls, right? So whatever happens to this stock, as long as it stays above 25.50, I'm making money, right? Because I already got that premium. I already got paid. So what if this comes back down to 27 or 28? Comes back down to that area, right? Well, it's still above my 25.50 put, isn't it? So why don't I make that money and then assign the stock to myself? Okay? So I would close this out, meaning I would close it and assign it to myself. Okay, I would create a closing order and I would actually buy the stock. Okay, now I'm not going to go through that right now, but just, gosh, every time I do that. So if I were to assign myself the stock, I would get it at the 25.50, right? So if it's up here, I just bought the stock at 25.50, and depending on where I am in my profit, I made, well, right now, if I did it right this moment, which I wouldn't, why would I do that? I still have plenty of time in my option, right? Still got 15 days. But if I did, and I said, you know what? Hey, I want to own this stock, and I have the right to assign this to myself. Okay, it's not technically a right, but I can assign this to myself at 25.50. Now I own Kohl's at 25.50, and I made $220. So not only am I in profit, okay, remember, we're assigning it. Assign at 25.50. So just pretend that you bought it Kohl's at 25.50. It's currently trading at 29.17, right? Minus 25.50 equals, use my calculator because quick math is not my forte. 29.17 minus 25.50. So I'm up $3.67 per share, and I made $220. How does that sound? Are you guys with me on that? Awesome. Yeah. Yes, that sounds fantastic, doesn't it? Well, guess what? That is a reality of what is happening this very moment. I could do that right, chicken dinner. I could do that right now. I could walk away with $220 and own the stock at $25.50. How do we find out how many shares you would own from that? So that's a great question. Here's the only thing that would be the problem with that. What is one contract equal? $100 shares. So if I did that, I would own 900 shares. I can assure you right now, I do not want to own 900 shares of Kohl's. Even 100 shares is my max, you know? Definitely not 900. So that being the case, this is where it gets a little bit more. Kohl's has the best deals, though. It certainly does, sir. So this is where we would start playing with it. We would start doing things. This is where we would close out 8 of our contracts. So just forget about the math for a second. Pretend that so $43 with max with 387 at the current price. So if we were to close that out 8 of the contracts right now, we'd make roughly $180 roughly. Okay, so we'd make $180, but we'd keep one of those contracts and we'd roll it, own the stock. Does that make sense? Everyone still with me? So everything is exactly the same. We're assigning the stock to ourselves, except this time we are going to, instead of rolling all 9 contracts, we're just going to roll one of them. Okay, so now that we know what we've done here, we have an opportunity. Let's go ahead and delete this. Goodbye. We have an opportunity with Bank of America. Okay, guys? How do we feel about owning Bank of America around $25? We had this huge breakout and you feel like you missed the boat, didn't you? Well, how do we feel about owning it at just say 25? Not saying that's where we want to put the option at, but how do we feel about owning it at 25? Well, it sounds a heck of a lot better than owning it at 27, doesn't it? Right? So same exact play, no difference whatsoever. We're going to leave everything as it is. Okay. So how we look at this is we look at 25, and let's put this on a vertical so we can see what it looks like. Okay. So they're selling everything with 50 cents spreads. Okay. I like to do it at about $1, but I'll get into the intricacies of that later. So look at something. This is very interesting. The further you go up, the less volume there is. So this is telling me that nobody is trading this. But look at what they are trading. They are trading the pants out of this 24.50-25 spread, aren't they? Right? There's a lot of options on this one. The open interest on this is huge, right? There's tons of options being bought and sold on this particular price. So what does that tell you, guys? That people like this. They like this strategy. I'm not saying that we want to follow the tide here. I'm saying that this is obviously a place of interest. So it kind of validates what we're trying to do. So if I were to put this on, let's just go ahead and take a look at this. If I were to go ahead and do this, I would sell. Okay, remember, this is the area that I'm looking at, right? I need to stay above this area. So I'm going to go back here. I would come back at 25, 24, 50. So I look at this and I would sell vertical. Okay. So I'm selling at 25 and I'm buying the 24.50. The only problem with this is I'm making 7 cents. And if I bump it up, I'm making 11 cents. Right? So that's the problem with this. Write this one down. I like now that again, this is just personal preferences. We're all going to develop our personal preference as we go on. But I want to get paid at least 20 cents for each dollar I risk. So from 25 to 24, that equals $1, right? Well, I'm only going to make 11 cents. That's pretty small. So if I were to execute this, I'm making 11 bucks. That doesn't sound very attractive, does it? So in order for me to get something a little closer to what I want, I've got to go way further into the money. And the problem with that is now I'm risking having to be a lot more right. Now I'm risking the opportunity, or now I'm risking the directional play here, meaning if it goes below this area right here, let's go ahead and pretend I'm putting it on vertical. Okay. So 26.50, drop this down to 25.50. Now I'm making 31 cents. That sounds a heck of a lot more attractive, which is great. Okay. Now my risk to reward is way better. But my risk is much higher in terms of this having to, or my bias has to be a lot more accurate, right? And also, if I want to take assignment on this, I don't want to own it at 26.50. It's kind of already at 26.50. So I know we said this is a great play that we want to look at. This is the problem with this play. So we either have to we either have to just take it and take that small amount of premium and get a better price to assign it, or we take the better premium and get a worse price when we assign it and take the risk of our trade not working out. Right? So that's something that we have to decide what we want to do. So if I'm looking at this, I feel fairly confident, right? All this is based off of, your instincts, your biases, and what you see. Well, I see a breakout here, and it is possible it could fill this gap, but we're above our 200 moving average. It's bullish. I feel pretty good. So maybe I will sell the 25.50, okay? And that makes me feel a little bit better about staying above and making money on this. And I still like getting in at 25.50. So let's go ahead and right click, vertical, flip this over to 24.50. We're only making 60 cents. It's pretty close to 20 cents. Not as great as I'd like, but on this one, we're risking $84. If I'm on a $100,000 account and I only want to risk 1%, I can risk up to $1,000. So 1,000 divided by 84, I can do 11 contracts, right? Okay. So these spreads are going to change tomorrow. They could be completely different. Right now, they're not very good. What the implied where is it? The implied volume, or it's where are we here? Missing again. Gosh. Okay. Well, I'm just having a heck of a day right now. Okay. Anyways, these numbers are going to change. So bottom line here is we have a good opportunity. So we can make this trade. So what I'm thinking on this trade right now, you guys, is let's see what happens tomorrow. If we can get a little bit better spread, I definitely like this trade. I want to get paid a little more to risk so much, right? So that's kind of my bottom line right now. Otherwise, I throw it on right now. So that's where we're at with BAC. There's other stocks that could be having this opportunity. We already know. That Kohl's is doing great. We are looking at other stocks that we're looking. Love, that's the other one. We know that Love is looking great. So we have opportunities to do the same thing here. But that's all I'm going to look at for today. So does that kind of give you an insight as to why we are going to be trading this strategy? I hope that was clear enough as to why we like that strategy. Does that strategy, do you guys comprehend that strategy? Does it make sense of why we're going to do it? I'm not asking if you understand and feel confident how to do it. More so, do you understand why we're going to do it? Good. Okay, Katie says makes sense. Good. Good, Satya, good. You sold at 26. You sold the put. What'd you sell? If you bought it at 26, you'd get closer. Yes, I know. Yes, you would get closer to the 20 cents, right? You get closer to that little rule. But the problem is that when you're short a put, Satya, when you're short a put, BAC, if you sold the 26 put, if it's pretty close to that, right? We only have a margin of 98 cents. That's not a lot, right? I mean, I realize that this thing doesn't move a lot in terms of volume the delta is low on this essentially. But what I mean by that is I'd rather have more room. And honestly, owning it at 26 isn't all that great anyways. Owning it at 25.50 sounds good to me. If there wasn't this huge breakout, if Pfizer didn't do that, if we had a nice normal close outside of this, that's when we would have bought it anyways. Right? So if you want to own the stock, what do you mean by that, Tony? So you sold at 26 if you want to own the stock. What are you referring to? Okay, while you're answering that, so I'm glad that makes sense. This is a strategy we are going to trade a lot, and you guys can see how well it's going in just one example, right? And this made a lot more sense because I got paid 43 cents. That sounded good to me, right? So Bank of America may not be in the best place right now in terms of how much we're going to get paid. But there will be other stocks that could have good opportunities. Like this could be better opportunities. Unfortunately, the spreads on this is enormous. We'll talk about that later. So anyways, I hope that was helpful, you guys. This is just an introduction to bull put spread. We're going to be trading this a lot. This just gives you an insight. Now you understand why we do it. So I'm going to stop the recording here.